In this video, I'm sharing one SPAC that no one really seems to be talking about, and it could double very soon. And it's not an EV stock, it's not built on hype. This could actually become a serious long-term investment. One last time with the phone microphone, let's do it. What's going on, everybody? My name is Matthew. Welcome back to my channel, and today we're talking all things Pershing Square Tontine Holdings, ticker PSTH. This is Bill Ackman's SPAC. This SPAC has given us the opportunity of asymmetric risk, which is actually an investment strategy used by many of the world's billionaires to create wealth. So you might want to watch this entire video. Give me the format. First, super quickly, who is Bill Ackman? A little bit of background. Second, why this SPAC represents asymmetric risk, and also what is asymmetric risk? Third, why is Pershing Square Tontine Holdings different from many of the other SPACs out in the market? And this is very, very crucial. Finally, fourth, who are the potential companies that PSTH might be merging with? So no time wasted. Let's get right into part one. Who is Bill Ackman, the man in the team behind this SPAC? This part of the video is actually also kind of important because right now PSTH does not have a definitive target, so if you invest at this point, you're kind of investing in Bill Ackman. Ackman is the founder and CEO of the activist hedge fund Pershing Square Capital Management, which was founded in 2004. At Pershing Square, Ackman usually tries to buy common stock and actively make changes with the company so the market can then realize the true value of said companies. He also likes to find companies trading at a discount and hold them until they reach their appraised value and sell for a profit. As of August 20th, the fund has over $11 billion in assets under management. And if you haven't been following them, Pershing Square has actually kind of been on fire lately. In 2019, the fund returned over 58%, while the S&P returned 31.5%, so an obvious outperformance there. And as of October 31st, since the start of 2020, Pershing Square has had a gross performance of 53.5% returns, 43.7% net. Meanwhile, the S&P 500 is up just 11% since the start of 2020. This year's outperformance is largely due to his well-timed hedge against the market during the initial Rona crash, which turned just $27 million into $2.6 billion. Right afterwards, Ackman went long on many of his positions and made another $1 billion. So clearly his resume is looking pretty stacked right now, but full transparency, it hasn't always been this way. There was a stretch of 3 years leading up to 2019 where Ackman's fund did lose money every single year, only slightly beating the loss of the S&P in 2018. However, now it seems like he has his hand firmly on the pulse of the market, perhaps why he's taking this SPAC opportunity, and that's what we're here to talk about today, the SPAC. So let's get right into part two, the asymmetric risk presented here. And what is asymmetric risk? Asymmetric risk simply means that the risk and reward in a situation are imbalanced. One is much greater than the other, and this is a business and investment practice used by the likes of Peter Lynch, Carl Icahn, and Richard Branson, and more. An asymmetric trade or investment is when the potential upside of a position is much greater than its potential downside, like risking $1,000 for the chance at $10,000 versus risking $1,000 to make $1,000. Now, virtually all long positions technically have unlimited upside. However, most long positions also have 100% downside, meaning they could go to zero. But in this case, Pershing Square Tontine Holdings, Ackman's SPAC, is asymmetric because it currently trades at about $24.60 per share. And due to the nature of the SPAC, with redeemable warrants at $20 per share and other things of that nature, the hypothetical floor for this stock should be at $20 before a merger or combination is announced. This means that as we wait for a merger announcement, the theoretical maximum risk here is about $4.60 per share, or about 20%. And when you compare this 20% maximum downside with the maximum downside of 100% on a normal long position, and considering the fact that they are both technically unlimited upside, it becomes asymmetric. And as an added bonus, if Ackman is able to find an acquisition target, which I believe he will, the stock will also jump massively. Not only are SPACs in a redonkulous hype cycle right now, but Ackman is looking for a legit company with serious long-term potential. He's looking for a mature unicorn and even a company that could eventually make it into the S&P 500. We'll talk about that more in part 4. For now, let's talk about part 3, Why PSTH is unlike any other SPAC out there. There are two huge reasons why PSTH is a different SPAC than anything else on the market right now. The first is the amount of capital involved in this merger. The total value of Ackman's SPAC is about $4 billion, while the typical SPAC is usually between $200 million to maybe $1 billion. Additionally, Ackman's own fund may co-invest up to another $3 billion when a target is identified, potentially bringing the total investable funds up to $7 billion. Now, the second thing that differentiates this SPAC is its structure. Pershing Square Tontine Holdings. What the heck does Tontine mean? I'm glad you asked. Tontine is actually an old annuity plan started in the 17th century where the last survivor enjoys the whole income. In other words, investors pay into a common pool of money and receive their proportionate share of returns. As members of the group die off, they are not replaced with new investors. Rather, the proceeds from the dead are then divided among fewer and fewer remaining members, so survivors quite literally profit from the deaths of other investors. It's a bit morbid, I know, but drawing parallels to Ackman's SPAC, the investors who sell and redeem their warrants, they're out. They're the deceased. But the people who stay in the SPAC, stay invested, they actually are distributed those warrants of the people who left. So the longer you stay in, the more you are rewarded. And again, this is completely by design. There's more technical stuff about how they're doing 1/9 and 2/9 instead of 1/3 for the redeemable warrants, but I want to keep this light and just know that the main idea is that Ackman is encouraging long-term investments in this SPAC. And this avoids those big sell-offs that you see after mergers are completed for different SPACs, such as what happened with Hyliion. So far, this seems to be working, as billionaire investor dubbed the next Warren Buffett now has a $400 million position in Pershing Square Tontine Holdings. And if you're curious, this is Seth Klarman. He was actually my quote of the day in my last video, just a fun fact. Klarman is another hedge fund manager who is a big proponent of value investing, which only makes me more confident that there is value to be found in Ackman's SPAC. Now let's talk about part 4, potential merger targets for PSTH. As we said before, Ackman is actually targeting mature unicorns, and they give us a great detailed kind of rubric of the companies they're looking for. This can be found in their SEC filing, but I don't want to read it to you because it looks really boring, so here it is broken down into 8 quick criteria. Criteria number 1, a simple, predictable, and free cash flow generative business. They want a proven track record of growth and profitability and predictable future financial performance. Criteria number 2, formidable barriers to entry. They want long-term competitive advantage and wide moats with low risk of future disruption. Criteria 3, limited exposure to extrinsic factors, meaning companies not really affected by macroeconomics, regulatory risks, cyclical risks, etc. Criteria 4, smashing that like button for the YouTube algorithm and subscribing to Matthew's YouTube channel. But seriously, if you're enjoying the content, I'd really appreciate it if you just turn that like button blue and come join the community by subscribing. Criteria 4 is actually a strong balance sheet, one that is conservatively financed with limited liabilities. Criteria 5 and 6, double whammy here, is minimal capital markets dependency and large capitalization. Companies with large enterprise values and long-term growth that could eventually put them into contention for S&P 500 inclusion. Number 7, attractive valuations, meaning the companies that are discounted relative to their long-term intrinsic value. Finally, number 8, exceptional management and governance, trustworthy, talented, and experienced management teams to lead the way. Now, I know that was a lot, but I loved every single one of those criteria, so I'm definitely on board. They're not going for a pre-revenue, pre-production, or early-stage startup that's hemorrhaging money every quarter. They're going for a long-term, high-potential, profitable company. Okay, now who is the actual company? I know that's what you guys all want to know. Originally, people were speculating about Airbnb, maybe Bloomberg, but the front runner in the rumor mill is currently Stripe. Stripe is a payments processing company that offers payments and billing solutions, payout solutions, financial services like corporate credit cards and business financing, and business operations products as well. Their customers include some pretty big companies, but they do face competition from PayPal. And in case you were wondering, this company definitely checks a lot of the criteria we just went through. They're not just a speculative startup. They've already raised over $1.6 billion, which hints at the fact that they're likely already very profitable. Back in April, Stripe flexed the strength of their balance sheet by saying that they currently have $2 billion on their balance sheet, which, by the way, kind of might mean they don't even need to go to the public markets for financing. They seem to be doing just fine, but you know, they're also growing at an incredible rate. Just recently, literally several days ago, it was announced that Stripe was in talks for funding at a $70 billion valuation or more. This is actually insane because in April, less than 8 months ago, Stripe raised $600 million at a $36 billion valuation, meaning they may have just doubled their valuation in less than a year. Stripe would obviously be an incredible acquisition if Ackman can make it happen, but it's all very much up in the air. Either way, I'm almost positive that PSTH early investors right now will end up getting a good deal. And worst case scenario, we don't, and we lose at most 20% of our money. The risk reward here is simply too good to let it pass up. But that being said, I'm not all in on PSTH or anything. The way I see it, this is almost like an unorthodox savings account. Either it will accelerate the depreciation of your money by tenfold, making it decrease by 20%, or it could be the best day of your lives and increase it by 50, 100, 200%. So I'm really just investing some of the excess cash that I know I won't really need at any immediate circumstance. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out our quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. If you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.